What's up, gold miners? Today we welcome Jason Yarusi to the show. Jason is the founder of Yarusi Holdings, a multifamily real estate investment group that has scaled to 3,500 units over the last 8 years. In 2017, Jason owned 0 real estate, and since then, he has amassed a portfolio of over $300 million across 7 states. And in this episode, we start off by diving deep into the journey, the lessons, and the systems that Jason has developed in scaling his portfolio to over 3,500 units. Later on in the episode, I dig deeper into Jason's philosophies to truly understand the things that he looks for in a property before he decides to invest in it. And then finally, to conclude the episode, Jason delivers an in-depth analysis of the current state of multifamily real estate and his unique approach to acquisitions in these uncertain times. So whether you've been investing in real estate for years or you're just getting started in your investment journey, Jason provides a tremendous amount of depth in this conversation, lots of gold nuggets for you regardless of where you fall in that range of experience. So without further ado, everyone, let's welcome to the program, Jason Yarusi.
The Gold Mine Podcast.
Jason, welcome to the Gold Mine.
Danny, great to be here. Thanks for having me.
I'm excited, man. This is going to be a fun conversation. You have now scaled to over 3,500 units around the country. Is that correct?
We'll say mainly just the Southeast, right? So I'm in, and even if you break it down even further than that, so that's true. We've accumulated a lot of units, but they're mainly down here in the Southeast, and we're in 7 states, but it's really just 7 different markets. We're not like, even Tennessee is where a large portion of my portfolio is. We're not in East Tennessee, we're not in West Tennessee, we're mainly here in Middle Tennessee. So although we're in a number of different states, we're highly focused on certain areas.
Well, I love that. And I definitely want to dig into the strategy and why you've chosen to kind of stay concentrated on specific markets. But let's kind of rewind the clock here, because I want to understand kind of what got us to this point. You didn't start off in multifamily, right? You actually started off owning and working in bars and restaurants. Is that correct?
Yeah. So pretty non-linear path, right? So I left school with a finance degree, had no motivation to go into that world, and ended up moving into New York City, right? And New York City breeds all kinds of opportunities, right? But many times, you don't seek the right opportunity at first, right? So I started working in bars and restaurants, just doing odd jobs, right? So working in bars and restaurants, doing construction at certain times, even, I was writing like education papers for people. I was just doing odd things, right? But with that, I wasn't really happy. Like you do things and you just go out on a path and you get stuck in this rhythm, right? And many times you're living a life that you look and you go like, how did I get here, right? And hopefully that's for the good. Most of us is for the bad, right? We look at things we're doing each and every day. We're like, man, I have no idea how I get here, but you do, because you're doing the same things each and every day, right? So I was just doing odd jobs, doing, bad habits, stay up late, drink at night, wake up late, like all the different things that just lead you down to the path of just not really going anywhere, right? Except where you actually are. So I was working at bars, and one night, I left the bar just angry at the world, and was riding my bike home across Manhattan, and I got hit by a car, right? I got hit by a car, got pulled out of the street, taken to the hospital, and, 2 days later, get out of the hospital. And my first thought was like, man, I got to get back to work because I need to make money for rent, right? And it was like that crazy cycle of just a pause being really like, hey, listen, all I'm doing is complaining about my life. And now that I have this thing happen, luckily I'm not hurt worse than I am, right? And lo and behold, all I'm thinking about is getting back to the life I don't want to be with, right? So I made an agreement with myself that either I choose that I just carry on and stop complaining, or I just try something different. But, where we mostly get stuck is I didn't know what to do different, but I just started to really kind of just do the opposite of what I was doing. Like, don't stay up late, don't drink at night, right? Like get up and like have like a purpose in the day, start working out religiously. And like lo and behold, slowly, things started to change in my favor. Instead of just, pessimistic moments, I started to have more optimism, and just things started to add on and carry weight in a positive way. So I went from working behind bars to going and open up a bar, open up a brewery that I eventually sell, before moving into the family business construction out in New Jersey when Hurricane Sandy happened. So we moved out there, helped my father really transform that business. He was doing, 12, 13 projects a year. And at DeCap, we were doing about 300 something projects a year at that business. So really helped scale that up before moving into real estate. And the question I really asked that got me to the path of why and how multifamily was that we just kept looking for a way to just control our life. And, everything from working in a bar to working in construction was just constant transaction, right? If we were there, especially in a specialized field, my dad was for construction, if we weren't actively there, there's no revenue, right? Because we're the one pushing forward. And with multifamily, we were able to put together a process and put together a procedure, right? A plan where we could go out there and improve these properties, but benefit others too, right? Put together a good team, allow the team to work the plan while we go and manage the plan, make sure it can optimize. And that led us into our first investment, which 94 units that we brought in Louisville, Kentucky. And that was 2017.
And since that time, you've gone from 94 to 3,500 units. That's pretty aggressive growth. I mean, that's an 8-year time frame. So we're talking like 300, 400, like 400-ish units a year, give or take, right? So that's not easy to do. So what would you say were the key pillars that kind of led to that massive growth? What were the things that you did differently that allowed you to experience that?
So it wasn't, you talk about it, but the 94 unit was the first year, right? And then we continued to grow from there, right? So it was, okay, here's our plan. Let's work our plan and let's pivot from our plan and adjust our plan as we go out there. So we really made sure that we honed in. The first one was in Louisville, Kentucky, right? Said, okay, why is this the market? Okay, we wanted to be there because of job growth was, there was always nominal population growth. There was job growth. There was massive job diversity, right? You have FedEx, UPS, GE, Churchill Downs, Humana, which now brought Aetna. You had the Yum Center. You had all these different things that were bringing people there. It's actually, targeted as the center of the U.S. because from a shipping facility, you can get to New York and Seattle in the same amount of time from shipping, right? So it has a lot of drivers that bring people there. Ton of workforce housing, right, that are all segmented in certain areas. So we really focused on these areas. And when we brought this, we wanted to make sure we had the right team in place, right? So everything from insurance partners, management partners, just a broker. So we put a lot of work just making sure that we had the plan down. And when the plan started to pay off, right? So that deal that when we brought in 13 months, we were able to cash out, refinanced almost a majority of the investors' equity. And then we ended up selling it about another 16 months later. So I think total in about 27 months for a very nice return on that project, right? But that was the first part to say, okay, here's the plan. Let's implement the plan, make sure the plan is working as we projected it to. And then from there, we'll start to grow from there. So then we brought about another 400 units, give or take, in Louisville before we started to continue to ramp up the process.
Yeah. So one of the things that I heard in there was that even though the growth has been pretty substantial, it wasn't necessarily linear. The first couple of years you took to refine the processes, proof of concept, make sure that you're not growing too fast, so to speak, at the beginning.
Yeah, it wasn't build to, jump out and, try to build the plane on the way down kind of an approach. It was, okay, we'll buy an asset. We'll make sure everything is working accordingly, right? Because, in real estate, there's your plan and then there's day one, right? And in day one, there's 300, 400 things that happen when you have a couple hundred people living in a building that aren't part of the business plan, whether you want it or not, right? And so that's been our approach. And that's probably, it's another reason why we're not in a ton of markets, right? We manage about 700 of the units, give or take, and your resources are everything. So if you're in too many markets, right, the things you need, you spend so much time just trying to find what you need when in fact, because you don't have the right partners in place to help you through the journey.
Gotcha. So you started off in Louisville. At what point did you make the shift, or did you start kind of transitioning to Middle Tennessee? Was there like a specific moment that happened, or was it like a gradual thing that happened over time?
Gradual. So we ended up moving here in 2020. I was born and raised in New Jersey, right? Lived in New York City for a while. We moved down here just because we just wanted to change, right? It was, I have 3 little kids. They were in and out of school with COVID. It was kind of just chaotic up there. We were talking about moving, and it was like, well, what's a better time? So we were thinking Denver, Phoenix, or Nashville, and we ended up settling on Nashville. And so we had just recently before that, we had a partner on a deal in Louisville, still our partner today, but he was down here in Tennessee and he found a great property here in Murfreesboro, Tennessee, where I actually live now. So we came down there, started doing the same analysis we were doing on Louisville. And at the time, we were beginning to sell out of Louisville, not because we didn't like the market. We were just finding there was things there that were pushing against success factor. And notably is that we were workforce housing. However, with COVID there, they were giving rent relief forever. They were like, they were past most markets. They just continue to give tenants money. And so there was almost no aspiration for tenants to go out there and actually pay rent because they knew that by the time you go to eviction, they would get saved. We were seeing that a lot across the market. Beyond that, it was hurting the workforce. We were finding the most difficult thing we had there was finding reliable maintenance people. For the first couple of years we were there, we had a great team. We never had turnover in maintenance. And then COVID happens and, really no one has to work because they keep getting relief, is that we could not find reliable maintenance people. I remember at a time, I think our management company there was offering like bonuses, like just ridiculous specials to try and get the right staff in place. So we were just seeing things from an operational point that we didn't like the direction we're heading. But at the same time, we were seeing historic rise in prices. We were seeing all these other things happening, right? So we were getting offers that really were putting us ahead of expectation on where our sell price, right? Where our investor projections were even in year 3 to year 5. And we're seeing that in year 2 and year 3. So we started to make the discussion to go and start selling at Louisville. So at that same time, we were finding other opportunities down here in Middle Tennessee. And so we slowly made that transition.
That makes sense. So you moved to Middle Tennessee and kind of started the process of aggregating portfolio in and around the area that you live in. By the way, Nashville is beautiful, man. I love it out there. I visited a few times and I'm a California guy.
All right.
So getting out to Tennessee, I mean, it's just a total change of pace. Yeah.
Sure is. Yep.
So I'm sure that you're loving it though. And you guys are still there, correct?
Still here. Yep. I'm still in Murfreesboro, Tennessee. That's right.
That's awesome, man. That's awesome. So you briefly touched on it and I want to kind of dive into this a little bit more. Operations, specifically asset management and property management. So it sounds like you are obviously asset managing all of these, but the majority of the portfolio sounds like you have a property manager in place. Is that correct?
Yeah. The larger properties, we tend to find really great property management companies. So here in Middle Tennessee, majority of our portfolio is managed by one company and they do a tremendous job. Like most of the time you're like, oh, property managers, they're like an 11 out of 10. They're just fantastic. However, on the part for smaller properties, we find there's always this delta in terms of expectations and performance. And so where we've jumped in is that the properties that are, 36 units, 29 units, 48 units, we started to pick up that we were spending more time managing the managers, right? We just couldn't find really the right fit from a property management size. So we, based on more need, right, started to manage these properties ourselves. And where this came in is that we have some properties that are not traditionally multifamily. So we manage also storage units. We also manage, our office space. So we manage some non-traditional sites as well with our management company where we can just do that more proficiently than we found that we were finding the management companies to do so.
At what unit count does that start to break? Meaning like, because you said smaller units. So is it like over 100 you get a property manager in there, or what's the threshold?
So if you can have on-site, and so large enough to on-site, now this can be a range, right? Like, you can put on-site at any property, but it doesn't, logistically make sense, right? So sometimes, if you have an outlier property in another market, right? Mm-hmm. I remember when we were selling out of Louisville, right? The hardest part is the last property we have was a 65 unit. And really from an analysis perspective, it doesn't make sense to have on-site, but it's almost too big to not have a full maintenance team or full staff, right? It's like right in the middle, right? So you want to find that sweet spot where it actually makes sense. And that can be 75 units, 100 units, but preferably, your cost comparison is that you want to have on-site for anything over 75 units. But the 75 to 100 unit breaker right there is that it doesn't make much cost difference between it, right? You're not paying more for leasing people because it's the same one person be able to handle 75 to, 100 units. So for us, if they can have on-site, typically we will be able to find a qualified property management company. If they do not have on-site, we're typically running that with our staff. There are a few exclusions, right? We have a 125 unit that we have on-site that we manage. Our team does a great job, but we manage that one. There's a few that are anomalies to that point, but just on a reference point, so about 75 units or larger, we're using a third party group that we've identified that matches our business.
Yeah. And how long did it take you to find that right partner though? Because I feel your story is kind of unique, most of the guests that I've had on in the multifamily space strike out time and time again. And then they're at some point, they're just like, screw this. We're just going to go full vertical integration. So I'm curious, like, what your process was to kind of identify and find that group, because it's rare.
Yeah. Well, we've had our difficulties too, right? That's why we started for the smaller ones, managing ourselves, right? Because we were just having just wrong partnerships. And we have in other markets, right? So in Louisville, the same thing, right? We ended up having, and there's that part. It's like it's a growing organization, right? So in Louisville, we had a great group as well, right? So, and what happened is that great group, the ownership had a conflict, right? And then one brought the other. And then all of a sudden, we had 3 properties that went fantastic. And then the 4th one started going horrible because the whole culture changed, right? And so then we had to make a change. So just because you start good does not mean that ultimately it's going to end well, right? My dad used to say that, the plumber is always great until the 3rd job. Then you got to find a new plumber, right? And that's a lot of times with the trade, right? But you think about it, we said, okay, do they handle workforce housing? Yes, check the mark, right? And so we don't want someone who manages single family. We don't want someone who manages new construction. Do they have, 3,000 to 5,000 units under management? Okay, good. Because another check to mark, right? If they have 100 units and we're bringing on a 50 unit, they're going to say, okay, yes, we can handle it. But then ultimately they're taking on 50% more than their company has ever focused, right? So we want a group that if we bring 100 units onto them and they have 4,000 units, that we're just a speed bump. We're just going to their operations. What's their back end system? What kind of operation system are they running? Like what property management software? What's the reporting structure look like? How frequently are we going to receive reporting? When can we expect reporting? Do we have a regional, right? Who's going to be our oversight on our deals right now? Are they working on comparable projects with us? Like any properties that we see in the area that work well. And then lastly would be construction. How do they handle construction? Do they have a team on site, or is everything like that will handle turns or handle parts? Do they have like a trade, a Rolodex of people, or does everything have to be subbed out? We have to go price every job, and it's going to delay our time frame from being able to turn the property.
You're clearly a systems guy, just based off of what you just said, right? Like, you've got a mental checklist. Like, these are all of the things, right? So how did you go about developing that mental checklist? Is it just trial and error? Do you have a process, like every morning or every week, you're kind of sitting down and you're like, these are the things that we need to, that came up, things that broke that we need to solve for in the future, or lessons that we learned that we don't want to make the same mistake again? Like, how do you go about documenting and kind of like creating these either like written SOPs or mental SOPs?
A little bit of all, right? So when we started going into the multifamily space, I just started talking to a lot of people and just really getting a read of how people operated, right? And just finding my path forward, right? And finding my path forward of what people were doing, right? So people that were buying properties themselves, people that were managing properties themselves, people that were syndicating properties, people that were using third-party management, and just understanding their processes, right? And how that process worked. And then I started implementing it and then finding what fits in our culture. So now, every Thursday we have a meeting on all the properties with all different property management companies, including our properties. Every Monday we have a team meeting, right? And on those, from a property management standpoint, we go into those calls. We talk on leasing, we talk on collections, we talk on marketing, we talk on open items, right? And we talk on construction. And that usually gives the landscape for how that meeting folds. So we hit on all points, right? And we've done that each and every week for, years now, because these properties are large, right? There's a lot happening. And if you say, hey, listen, we'll just talk on a property once a month, you can have so much happen within that month that, the ship is going the complete opposite direction and it takes forever to turn the ship again, right? And so we make sure that we keep our finger on the pulse very actively from a operations perspective, because there's many things that we constantly have to monitor exactly as they're going throughout the process.
So when you're identifying these properties, right, when you're going through the acquisitions process, what are the things that you're looking for?
Yeah.
Right. Because at this point, right, you've got your systems in place. So I'm assuming that you're not just going to go and buy any property where, oh, this one looks like it could be really good, right? Because I think at first, like a lot of investors, they kind of approach it with like oh yeah, I don't really care. Like, as long as it's a good deal, right? But eventually we figure out, okay, well, right? Eventually we figure out like not every good deal is a good deal for you.
Yeah.
Right. So what are the things that you're looking for now?
So again, we're looking at workforce housing properties, right? And so if the sweet spot, right? So say we were finding a 100-unit property, we're trying to identify something that's been underperforming based on a number of things, right? It could be that it's not being optimized because it's been run by a long-time holder, right? A long-time owner, right? We could look for areas that we can grow revenue and we can optimize expenses. Those are the simplest points. So how would that look, right? So 125 units here, owned it, throughout. The family built it. They've owned it forever, right? All of the rents today are $1,100 and $1,300. The rents when we brought it were $550 and $650. Well, you say, well, why didn't you just raise rents? Well, you just had people there forever, and it's easier to keep it occupied, right? Than to go and vacate a unit and have to renovate a unit. Also, many times the goals are misaligned, right? From an owner who's owned it for 35 years, they're asking themselves, wait, I'm going to spend $5,000 to $10,000 to go renovate a unit to get another $500. That doesn't make a lot of sense to them. But from us, doing that and optimizing a property and pushing the bottom line creates extensive value to the property, right? So our goals may not be aligned with those. Then looking at expenses, many times you'll see that contracts aren't optimized. People just roll over contracts. It could be everything from trash to landscaping year in and year out, right? Or they'll have utility runoffs where they're not properly billing back costs to the tenants, right? So they're not seeking other income, or they're not optimizing their expenses. They're have too much overhead or too much payroll, right? So we'll look to see, when we know a market, we'll look to see what's matching the market and what's not matching the market.
Yeah.
And typically just bridging that gap. But on the same part, we'll redo the landscape, right? Everything from new marketing, where there might not be any marketing, which is a plus to us, right? So we can go in there and completely bring the property online. To change everything from a facelift, could be landscaping, could be as simple as painting the buildings, of course, new signage. Depending on the social media, we may completely change the name and just rebrand the property. Then you look to do the interiors, and we'll make the interiors match the market. Typically go in there with a new paint scheme, LVP flooring. Either cabinets will be redone or painted. Countertops will either be redone or resurfaced. We'll change out the hardware, change out the lighting, change out any of the hardware throughout, from doorknobs to even just the quote unquote the knobs on the cabinets. And then for the bathroom, same thing, new light fixtures, new vanity, potentially new toilet, change out all the outlets and change out all the outlet covers. And that's not a huge expense across the board, but it can really freshen up the property and really bring it to market. So we look for things that simply have just been kept instead of optimized. And it sounds like a very simple terminology, but when you can do that, you can find a lot of areas where you can grow revenue, but while at the same time optimizing expenses.
That makes sense. And honestly, I mean, coming from a construction background, I'm assuming that you obviously had some like inherent advantages, just because you can come into a property and look at it a different way than, say, someone who's working, I don't know, like a tech or something, right? And they want to become multifamily experts. It's a totally different. You're coming from a totally different sector. At least you had that that inherent kind of like exposure to renovations and value add projects. Were you doing a lot of multifamily renovations in the construction business?
So my dad handled very heavy construction project. He actually lifted and moved buildings. So like homes, he would lift them up for flood reasons. He did that for forever. So I'm very versed in heavy construction. And where that helped is that, you can identify whether or not this is a real problem or not, right? That's the biggest advantage I have here, is this a real problem, or is this something that everybody sees as a problem, but it's not really a problem, right? But in the same time, I know how difficult, heavy construction projects will be, right? So I try to avoid anything that's an environmental issue, anything that's got a really big foundation issue, right? Anything from that point that's, you get into some things like Pacific breakers or aluminum wires, things that are going to be an insurance risk and just very costly with insurance, right? Those are the things that typically we'll push back on, or if not, it won't be the right deal for us.
Are you GCing these projects as well, predominantly, or do you have someone out there? Are you subbing out?
Our mix. Our team may GC, especially some of the properties that we manage and oversee, right? So typically we will do that. Third party, majority of the time, we'll have a separate GC that will run the projects.
I see. Yeah. Well, even still though, I mean, once you've seen enough of those, you can start to understand what realistic expectations are versus where you're kind of getting the raw end of the stick, right? And I think that's really the main issue with outsourcing the GC. It's not necessarily that it's not the outsourcing. It's where are all the gotchas, right? And where are the improper expectations being set? Because I think that's where a lot of people get stuck, right?
And we're trying to keep the same plan too, because one thing that's that the silent killer that people don't realize, and like anybody who flips a home knows this, it's the time, right? The time from start to completion, right? So because all the carrying costs, right? It's the same thing with a unit, right? If the unit goes vacant and you spend 2 or 3 weeks trying to get quotes, and then all of a sudden another 2 weeks to get the project started, and then another 2 weeks to get it completed, then you start marketing it. Now a unit is vacant for 3 months before it's leased out, right? But if you do the exact same thing every time, you can walk in your unit, start tomorrow, and that 3 months becomes 3 weeks. Think about how much revenue is created by just cutting down 2 months and a week of vacancy loss, right? And so that's a substantial gainer on the property.
One of the things that I'm noticing as we're kind of like just talking here, Jason, is that you have a very like pragmatic, practical, I'll say like even disciplined approach to all of this, right? It seems very systematic. And then in my notes, as I'm reading, I'm like, yeah, well, he wakes up at 4:32 every single day. So I'm going to pivot real quick and then we'll come back to the multifamily. But why 4:32 and every day? I mean, that's crazy, man. So talk to us about kind of like your philosophy there and how that's translated over to your success as an investor.
Yeah, and all transparency most days, and so that's where it goes. Yeah. And for many days, it was a good part. But you know what happened is that when you give yourself cushions, right? You give yourself guardrails, and you never step out to see what you can actually do. And so, when we talked earlier about changing up just my life, right? And just making these small changes. We say, I should wake up earlier. Okay, well, I woke up at 8 today, so I'll wake up at 7:30 tomorrow. Well, 7:30, you're like, maybe it's 7:40 or 7:50. Yeah, it's 8 o'clock again, right? There's always these little gray areas. When you give yourself, an inch, you take a mile with yourself, right? Because there's no one here. It's not like, there's no one telling you to get out of bed. No one cares you get out of bed. If you don't get out of bed, the repercussions really are more against you than anything else. So I started saying, okay, listen, I have to make a change. I want to get up earlier, 5 o'clock. Well, don't do it. 5:30. Well, what can I do? Okay, well, 4:32. So 4, 3, 2, 1, go. Just get up. Because you find that once you're out of bed, you're out of bed. You typically don't get up and be like, I'm out of bed now. I'll just go back to bed, right? Yeah, just the second you're up, right? Yeah, and so I get up, throw water in my face, go out there, have a glass of water, meditate, get into do a workout, right? And then you're going, then your day starts. And when you do this, you start to take back control of the time that you have, because as you know, like anything, right? Like the day just goes in a direction you have no control over. But if you can control the space in the morning, you can be more in line to be ready to go and face the challenges, right? Because if I was here, woke up late and the whole day I'm rushed, and I begin to this call rushed, right? And then I wouldn't be able to be here with you because I'm thinking about, hey, I was up an hour late, and so now I didn't get these 3 things out of the way, and now I have these 4 things to do after this, and everything just feels chaotic. And I was living so much in a chaotic life that as soon as I took back control and was able to create a calm start to my morning that I controlled, I find that as things come up today, just like in the world of real estate, things are going to happen that are unexpected all the time. And the more I can be clear in my mind and clear in my conscience, the more I can make a direct decision that will benefit us, instead of me having so much drawn on my mind that I can't be ready to make a good decision when that time is needed.
I see. Well, I think that's, that makes a lot of sense to me, man. Like the chaos is real. The chaos is very, very real. I was just really curious about the 4:32. So you answered it though, 4, 3, 2, 1. All right, now I got to ask the question: what time do you normally go to bed to wake up at 4:30?
It varies. 9 o'clock is a good barrier. 9:30, good barrier.
Okay, all right. That's actually that's pretty good. Then you're getting like 7-ish, which is not bad. You have kids?
I have 3 kids, 6, 8, and 10. So half of it is determined by trying to wrangle in little monsters to bed.
Makes total sense. Makes total sense. What would you say? Because here's the thing, man. Like what I admire is, you're a parent of 3 and you've got this thriving business, yet you still manage to keep the daily disciplines going. And I think that that's something that most people, they allow things like success in business. They allow things like I have 3 children to become the reason why, the excuse why they don't, oh, dad bought.
Mm-hmm.
Right.
Yeah.
So, I gotta commend you on that, because there's so many people out there that allow these things, the things that you've accomplished and the things that you've kind of begotten in your life, to become the reason why they no longer stay disciplined and no longer stay committed.
Non-negotiables, right? And that's a thing that you have to create yourself, right? And so non-negotiables, right? So I'm going to get up and work out, right? Most days I'm taking my kids to school. I'm going to coach their sports. So, I coach, just got done coaching soccer, but now we're in the, flag football, and then football will start. So like I coach their sports. So like I have to make sure. So what that means, right? Like, most of the time we set the work, and like the work is a very priority. We really value our investors, right? So take this, make sure this is set in the right way, right? But I set the priority of like, I'm going to be with my family. So I have to make sure that when I'm at work, I'm being most proficient with what I'm doing. Instead of coming in here and doing 15 things that literally have no value in a day or not helping anything forward, right? I have to make sure that I go and use the time accordingly, because I have set expectations of what's going to happen before the day starts and then when the day is getting to the end.
Yeah. I love that, man. That's awesome. And you also have a podcast, correct? The Live 100 show.
Live 100, correct. Yes. We actually have, we have a multifamily podcast called Multifamily Live that we do once a week. And we have the Live 100 podcast as a podcast I do that just talks to breaking habits and building the life you want. And I find the change and the shift really becomes mentally first before emotionally and physically, right? You have to mentally make that choice, right? And the choice usually comes to be self-aware of how you're showing up. And that was it, right? A lot, what I talked to earlier was just being self-aware, like, okay, I'm really not showing up in a great space. So how can I expect great results, right? Usually our expectations are different than our actuality of what we're doing, right? And when we could set the expectation based on what we're doing, we either have to choose one, reset our expectations and say, okay, I'm doing chaotic things. And so it's no shock I'm getting chaotic results. Because many times we do chaotic things and wonder like, why aren't I doing great? Why haven't I met the person in my life? Why aren't I in shape? Why aren't I not a millionaire? Right? But you're out there being reckless, right? But when you can reframe and say, okay, well, if I want to be this person, right? What are the steps I need to be doing right now that are away from the chaos? What steps should I be doing? If I want to be Danny Gould, I want to be you. I want to be here, coming to be you. Like, what steps should I be taking to be that person? And that's usually the path that when we start down, you start making better decisions. And of course, the consequences are better results, better actions, right? Which leads you to the new truth of the new life that you're looking for in the first place.
Yeah, that's awesome, man. Well, for those that are interested in listening to Jason's podcasts, plural, we'll go ahead and link those in the description below. Show them some love if you've enjoyed what you've heard today. And awesome. Well, I want to pivot back now into the multifamily and obviously you've had a tremendous amount of success over the last 8 years. What are you seeing right now, though? Because the last couple of years in multifamily have been a little chaotic, right? They've been probably a little stressful. It seems like you've been able to weather the storm for the most part, though. So what are you seeing right now in the multifamily sector? Are you holding off on acquisitions? Are you still buying? Are you selling? Kind of like, where are you at right now?
So not really selling. I am selling one project that we just got a very aggressive offer on, a cash offer, but the majority of it is we are still acquiring, but we're acquiring really in our home base, right? So we're acquiring just around here in Middle Tennessee when we have our best operation, our best standpoint, because we've been walking into a couple of opportunities that really weren't aligned with the market, right? We've walked into a couple of opportunities where sellers are selling because they've been longtime sellers and they've had some outside force that has forced them to sell, right? There, one was, the patriarch passed away, right? So the family wanted to sell the property. Another one was, family dispute. They were breaking up, so they were selling his assets. So we've walked into a couple opportunities that were based on just timing, right? But being in our backyard really helped because we were the first ones into those properties, right? But in a stance, it's of course been crazy, right? historic rise in rates, really, drew out a lot of just unexpected natures out there. The lending environment's been very difficult and very unsettling, right? Just investors just don't know where and what side to be on, right? So from that side, we're still buying very actively, but we're making sure that we're really finding deals that are very opportunistic to us. And that's worked well because we've been very focused on where we are.
Got it. So you are still acquiring then, is what I'm hearing.
Yeah, we've brought between now and last year, like a year and a half, we've brought like 700 units, maybe like 800 units, give or take.
That's pretty good, man, because most people are not acquiring right now, or they're in I don't want to lose my shit sort of mode, right? Like I'm trying to like not go bankrupt right now. So the fact that you are still acquiring, what would you say are the reasons for, what would you say are the reasons that you've kind of been able to buck the overall trend in the multifamily sector, where so many people are losing properties or, fighting, clawing and doing anything that they can to like not lose a property right now?
So we had, we'll just say, the fortuitous choice to really not put on floating rate debt. And so we had one out of all of our projects that had floating rate debt, and that lender they were nice, but they were very difficult. I think they were drawing off a line for construction. So we just couldn't get CapEx out, like the draws out. It was very difficult. So we got that out to a bank loan, and we started putting out bank loans a number of years, a couple of years ago. And bank loans are not the best terms, right? So that you might get a 5-year, sometimes amortize over 20 or 25, maybe you'll get a year or two of IO. But you're typically going to get fixed, right? You're typically going to get fixed. You know where you are. Right. And so the thought process behind this was like, okay, the terms going in work for the deal, not the best terms for a deal, and go to agents, go to other points, but prepayment penalty on the back end is typically pretty limited, right? So you do this, or we'll go to credit unions. So here's where we stand, right? So we buy these deals, put 5 years on it, right? And in year 2, if the market turns around and we see the Fed drop rates, right, and a ton apart, we'll go either sell or refinance without much consequence. If the market is still, unwavering and just a little bit unsettling, well, we just hang tight, right? And so that's been our business plan right now, is just finding fixed rate debt where we can have cash flow and reserves continue to operate. Now, we still have some challenges on some properties where even with it is like, we have a property in Nashville, and it faced, property's great, looks beautiful, but Nashville had like 35,000 units come online in a very short time frame over the course of 2 years, and the absorption went to negative absorption. So you had Class A properties that were coming online that were doing 3 to 4 months of free rent. And so I have a workforce housing property, and even when you have Class A offering 4 months of free rent, you see people stretch, and so that was affecting our prices, our rental prices. Now we finally seen ourselves go back to positive absorption, right? But we had to weather that storm that wasn't part of the business because you weren't seeing that, with COVID, and then with rates dropping. COVID, you had all the pent up demand of this housing being built that finally got released from permits. And then everybody started to build things when interest rates went to zero, right? So you had all these things come out of Nashville. So there's constraints you see that we've had to deal with, right? And we're finding ourselves on the other side of it. But those are some of the challenges that we've seen in the markets.
Got it. Now, where do you see things heading from here? Because, and I'm sure that you've probably seen the same thing, but like what I've experienced over the last couple of years is a lot of folks in the commercial sector, and I'll leave it, asset class agnostic, right? Because I'm mostly focused on hotels. You're obviously in multifamily, but like pretty much regardless of the asset class, the predominating thought was that in 2023/4, we were going to start to see the blood, right? The blood in the street sort of thing.
Yeah.
But here we are basically middle of 2025 now, and we're still kind of sitting here and waiting for the real carnage to begin, right? We really haven't truly seen the pain yet. So are we going to see that, do you think? Or like what are the things that we should be anticipating here in like the next 12 to 24 months that you can at least that you can foresee? Right.
I think the maturities in the Class A are going to be interesting, right? Because of the valuations and the loan resets. And so where those loans were priced, right? that could be interesting as they go, right? But where things have been held up is that rental rates have stayed aggressively high, right? Because of, again, in most places, absorption, right? There's not enough housing. You can't be a renter and say, I want to go buy a single family home because of where rates have gone, right? You can't afford it because of where single family homes have gone. So you're going to stay renters for longer, which it keeps your occupancy up. And so you have many sellers being like, wait, so why should I sell right now? Right? I don't want to take a lower price, and I'm 95% occupied, and my rental rates are higher than I underwrote. So like, what am I doing? Right? So if they don't have some overarching loan reset or maturity lingering over them, they're not really pushed to sell, right? Because there's not that panic button just based on where the renter demand is. So I'd be hard sake to say that, there's always some parts of the market. I think different markets will face different constraints, just like anything. It's not like the whole United States doesn't face the same pressures at the same time, right? So some markets will feel more stress than other markets, but I don't think we're going to have this overall massive carnage just based on how strong the renter pool's been for these properties.
I mean, I get that. I totally understand that. And at the same time, what you just hit on right now is actually where I think a lot of people were kind of getting that data from, or that sense of we're going to see blood in the streets. Is not necessarily, well, if the rental market was garbage, then I mean, I think that'd be one story. But despite the rents, I think that the main headline here are the loan maturities, right? That are coming up, and where these guys got their rates, where these guys got their loans at to begin with versus where they're at right now. Right. And that delta, that spread, a lot of these operators didn't underwrite for a 3 to 4% increase in interest rate over, a 5-year period. So, or a 10-year, however long their loan was for. So that's kind of where, I'm stumped, because a lot of these loans have already theoretically or on paper matured.
Correct.
Yeah, they're working things out with the bank. We're in one of my other guests said the delay and pray part of the cycle, right? Where you're delayed. The bank's like, yeah, just 6 more months. It's okay, 6 more months, right? So at what point?
Well, the lender also has to say, do they want to take this loss? Like, do we want to write this off, right? Like, what's the reserve for this? So like, depending on, Trump, he said the thing like, if you have $1 million loan, it's your problem, but if you have $100 million loan, it's the bank's problem. It's kind of, if you ever think about that in the way you said it, it's kind of true, right? Depending on a lot of these buildings, right? The banks don't want to take back this because it's a liability for them, especially if you look at just the office space and stuff. And sometimes their hand is forced, but the bank is also looking, that's not their business either, right? And so to go and operate, so they're hoping that they can work this out as well.
Yeah, no, that makes sense. So your suspicion is Class A buildings. Why Class A?
So market specific, right? I think the way where a lot of those were built in a time that a lot of those were 2022, 2023 when they came on, they were built with very aggressive lease up strategies and the anticipation that they would be able to get out of their construction loan into permanent debt that would meet the demands. So I can say that, but in the same part, you can look at properties that had very aggressive lease up strategies and just rate increases for a lot of tertiary markets too, that I could also see them being a pressure point too. And those were, if I was a bank, I'd probably most likely want to, work with the builder who's got a bigger balance sheet and a bigger net worth with the Class A property than probably some of these tertiary properties where you can just see it's gone completely sideways and you don't know a path forward.
Interesting. Very, very interesting. Yeah, man. No, I mean, I think that it's good hearing this perspective, right? Because a lot of the other multifamily operators I've talked to have not provided, I think, this much depth to their analysis. So it's an interesting, I think a lot of what you said makes sense to me. I guess the reality is like, we'll wait and see, right? Well,
that's, we'd be in a different spot. We could predict where we're going, right? And
100%.
In foresight, we thought we'd see more rate increases, but we also never thought we'd see historical rate increases. We thought we'd see rate decreases. There's that big push-pull right now between, Jerome Powell and Trump, push and pull, and like, you don't know which direction it's going to go, right? And so every month is like a new month, right? It's like a new world, right? But if we drop 25 points, is it really going to do that much? really.
Not really.
But it would just be, it will give the energy to lenders thinking that we're going in that direction, which might make our spreads, just might make our lending opportunities a little more advantageous. Where right now they're like, I know a bank that was increasing rates. They're like, we don't know where we're going. We think we're taking rates up. I was like, oh, okay. So you just have to look at just the environment and say, okay, what's the chess play here? Right. Yeah. And the chess play, we just, like Jerome Powell keeps saying, we need more information, right? That's what we need.
Mm-hmm. Yeah. No, I totally agree. And we're definitely in an interesting phase in the cycle. What would you say though to investors out there? Obviously you're raising capital for these deals, right? So you're what's the narrative, right? With investors that kind of come to you with these concerns, like, hey, the market this and interest rates that, and so and so said, my friend said this about the market. How are you handling kind of these concerns and objections as they come up with the LPs?
We can only speak to our truths, right? We can speak to what we do, where we are, and why we're doing it, right? And that's all I can do. I can't, I can't tell them what's going to happen in the future, but I can say, here's what we're doing with this business plan. Right. Here's why we're doing it. Here's why we believe in this theory. Right. Here's why we believe in this process. And here's what we anticipate to do with this deal. And here's why we're using the set loan. Here's why we're using the certain assumptions. Right. And a lot of these things, like the two deals that we just brought, our market rates, we're underwriting at like 80% of the market rates for the deal. Just as our anticipation with investors, compared to where we're seeing rates out there. And we're just doing where before that would have been our conservative plan. Now we're doing that as our base. And so even with the conservative plan, the deal's still working. So we have a lot of runway for, anomalies to happen, a very big portion where the deal doesn't meet and the deal still will pencil out and provide comfort for investors. Now, is there certainty in anywhere in the world? No, but we've tried to eliminate as much as possible when going out there to find new opportunities.
Yeah, I mean, that seems pretty conservative to me, like 80% of the current market.
Correct.
I mean, yeah, that sounds a lot would have to happen for that
100%.
for it to go down to 20%.
And it also speaks to how good, we've found very good opportunities and how good the opportunities are that they're still working at that price point.
Yeah. Yep. Super interesting, man. Yeah. Well, Jason, it's been awesome having you on, and you've been a wealth of knowledge, a wealth of information. For those that want to get in touch with you, learn more about Yarusi Holdings projects moving forward, they can visit your website, I'm assuming, or?
Sure. Yeah. You go to yarusiholdings.com. You can learn more about us, our company. If you want to talk about investments, there's a link to schedule some time with us or our investor portal there. Go to our podcast, right? The Live 100 podcast with Jason Yarusi. You'll find it all the places you find podcasts.
It's awesome. And I will go ahead and link all of those in the description down below, so you can go ahead and find those down there. Jason, before I let you go, you're not off the hook yet. I'm going to let you leave the audience with one final Gould nugget. Take it away.
Smile. I think we deal so much with moments, right, that we forget to smile. Right. Even when I said smile, you smiled right there. Is that, we're always in such an intense nature. And I find myself in that same world where when we scan out, time goes very fast, right? I see my kids, they were just born yesterday. Here they are 6, 8, and 10, right? And you can spend that so much time building everything without living at all. And so smile in the moment, even if it's tough, you'll get through it. The things, I try to separate problems from 5-second problems to 5-year problems. If it's a 5-second thing, just get through it. Doesn't matter. You're never going to remember it. If it's a 5-year thing, then put your focus on it, right? But I treat everything like a 5-year or a 5-second problem, or a 5-year problem, even if it's a 5-second problem. So just be in the moment, enjoy it, go out there and do good things and just enjoy it.
Love that, man. Wise words from Jason Yarusi. You've been awesome, man. Thanks for hopping on.
Thank you.
All right.